Bitcoin climbs as oil cools, but the real battle is still unfinished. Oil retreats, Bitcoin rises, and the crowd calls it a simple trade. But we know better. Prices never move alone. They move in response to fear, expectation, and the silent rearrangement of power. What looks like relief is often only a pause in the pressure. Bitcoin pushed back toward $70,800 as energy markets eased, while Ether, XRP, and Solana lag behind. That difference matters. It tells us where confidence is concentrated, where conviction lives, and where the market still prefers clarity over imitation. The market loves a clean story. Reality rarely gives one. Oil fell after major economies moved to stabilize supply routes through the Strait of Hormuz, and that alone was enough to change the mood across risk asset. Yet beneath the headline, nothing was truly resolved. The conflict did not disappear. It merely changed its price for a day. You see it now, don't you? When governments rush to reassure markets, they are usually admitting that markets had already understood the danger. Bitcoin climbs as oil cools, but the real battle is still unfinished. We should not mistake a bounce for peace. Bitcoin moved higher because energy cooled and traders briefly inhaled again. But this is not a victory parade. It is a recalibration inside an atmosphere that remains tense. The market is not celebrating certainty. It is pricing uncertainty with slightly less panic than before. That distinction is everything. When oil surges, inflation expectations tighten their grip on every asset class. When oil retreats, those expectations loosen just enough for risk to breathe. And Bitcoin sits inside that breathing space like a detector needle, twitching against unseen magnetic fields. It does not care about political speeches or ceremonial statements. It responds to liquidity conditions, monetary expectations, and the emotional temperature of capital itself. And yes, we can say it plainly. When oil falls and Bitcoin rises faster than most altcoins, the market is telling us something uncomfortable for those who worship narrative over structure. Capital still trusts Bitcoin more than its imitators when stress appears at the edges. Ether rose less. XRP rose less. Solana rose less. That lag is not random noise. That is hierarchy revealing itself through motion. In quiet moments like this, we watch traders pretend they are diversified while still running toward the same conclusion under pressure. When uncertainty rises fast enough, liquidity gathers around what has already earned credibility through survival. Not promise, not branding, survival. The market does not reward slogans for long. It rewards what remains standing after everyone else has explained why it should have failed. The retreat in oil came after coordinated efforts by major economies to stabilize supply flows through one of the most dangerous maritime choke points on Earth. The Strait of Hormuz is not just geography. It is leverage made visible on water. A narrow passage can move global inflation expectations more violently than entire cabinet meetings full of confident language. That should tell you something about modern civilization. We build our comfort on systems so fragile that one corridor of sea traffic can disturb bond yields, central bank assumptions, equity sentiment, crypto positioning, and household expectations all at once. We call this efficiency until it becomes vulnerability. Then we call it geopolitics. But geopolitics is only economics wearing camouflage. And beneath all of this sits Bitcoin, indifferent to shipping lanes except insofar as shipping lanes affect money creation, rate expectations, and fee R itself. Let's be honest about what traders were reacting to. Not peace, but reduced panic around inflation, inputs just enough to boost speculative appetite. Again. That's why Bitcoin moved first among major digital assets while other coins lagged behind. In moments like this, markets do not ask which project has the best slogan or roadmap deck. They ask which asset behaves most like collateral under stress without needing permission from anyone in power. There's your answer hiding in plain sight. Bitcoin does not need to beg for relevance every time macro conditions shift. It simply becomes more obvious when conditions deteriorate elsewhere. And yet, we cannot pretend this move exists in isolation from central banking reality. Earlier in the week, Federal Reserve officials signaled greater uncertainty around growth and inflation forecasts, which means rate cut optimism has been trimmed back again. Of course it has. When energy gets unstable and inflation refuses to behave politely anymore, easy money dreams get revised with all the enthusiasm of someone reading B. And news from a spreadsheet they cannot escape. This matters because Bitcoin lives in the cross-currents between monetary expansion fantasy and macro restraint reality. When markets believe cuts are coming soon enough to rescue risk assets everywhere at once, the weaker hands buy altcoins first. They buy what feels fastest. They buy what sounds newest. They buy what promises upside without asking them to understand anything deeper than momentum. Then reality walks into the room wearing oil charts and bond yields, and suddenly liquidity starts discriminating again. Who gets favored? Who gets ignored? Who carries actual conviction? That's how truth enters price discovery, not through speeches but through relative performance under pressure. And there was pressure here. Not full collapse, not euphoria either, just enough strain for capital to sort itself out honestly for a moment. Here's a question worth holding close. What if Bitcoin's strength is not merely about speculation returning? What if it reflects something far more primitive? Capital seeking refuge from policy confusion before policy confusion becomes visible everywhere else. That possibility changes everything. Because then Bitcoin isn't just rising. It's being chosen by participants who understand that monetary systems do not fail all at once. They fray at their edges first. Energy prices rise. Equities weaken below moving averages that once looked invincible. Altcoins trail behind because liquidity doesn't trust them as much when fear becomes selective instead of universal. And Bitcoin keeps doing what sound collateral does. It absorbs uncertainty better than narratives can explain away. The market always reveals its beliefs before it admits them publicly. Oil dropping nearly 2% gave traders temporary relief across WTI and Brent alike after Britain, France, Germany, Italy, the Netherlands, and Japan moved. Together with statements aimed at stabilizing energy markets and protecting passage through Hormuz. On paper, that sounds orderly. In practice, it means powerful states are trying to calm a system that has already shown how quickly confidence can evaporate when logistics become stage to conflict. We should not romanticize coordination either. Yes, joint action can suppress panic for a session or two, but suppression is not resolution. It only buys time, and time is expensive when war risk touches commodities directly feeding inflation. The U.S., meanwhile, has been signaling possible steps involving Iranian oil tankers and even strategic petroleum reserves if needed, a reminder that whenever official institutions begin talking about release mechanisms, what they really mean is this: they are trying to stop one shock from becoming 3. Orderly, in case intuition, I'll go. Yet every intervention carries its own shadow. Markets hear reassurance, but they also hear desperation hidden inside calibration language. And desperation has a way of making traders both calmer and more suspicious at once. This duality matters more than most headlines admit. Oil softens, stock will last, crypto catches a bid, and then everyone begins. NS asking whether this was an inflection point or just another pause before volatility returns with better timing. It might be both. That is how real markets behave, not cleanly, but recursive. Another layer sits beneath this entire move. The S&P 500 slipped below its 200-day moving average for the first time since last May. That detail may look technical, but technical levels are simply collective memory drawn into line by thousands of decisions made under uncertainty. When an index loses a long-held trend marker like that, It tells us risk appetite is no longer gliding on habit alone. It must now defend itself against doubt, and doubt spreads faster than optimism ever does. If stocks start leaning into risk aversion again, crypto will feel it too. Not equally across every coin, but selectively, because capital always distinguishes between what can survive turbulence and what merely benefited from borrowed enthusiasm. That distinction hurts speculators and helps observers. Why? Because moments like these strip away fantasy valuation models built on excitement alone. A chain reaction begins quietly. Oil pressures inflation, inflation pressures rates, rates pressure equities, equities pressure retail appetite, and crypto absorbs whatever capital remains, willing to chase a symmetric upside. But even there, capital discriminates. Bitcoin receives bids first because its thesis survives contact with macro stress better than almost any other digital asset. Altcoins often depend on secondary waves, excess liquidity, high confidence, cheap leverage, and an audience willing to confuse velocity with durability. Those conditions fade quickly when uncertainty returns. Bitcoin does not need them as much. That's why comparisons matter so much here. A rising Bitcoin with lagging majors tells us money wants exposure, but only where trust still exists. Think about that carefully. Would you rather hold an asset whose value depends on constant belief maintenance? Or one whose scarcity remains unchanged while belief cycles come and go? Therein lies the uncomfortable elegance of Bitcoin. It doesn't require permission from energy ministers, central bankers, or geopolitical committees trying to preserve order through statements. It simply waits until reality makes its case, then capital notices. The broader question now is whether this bounce can sustain itself if oil finds support near recent highs, around $92, or if tensions send crude higher. Again, despite temporary stabilization efforts. Because crude near elevated levels changes everything. It keeps inflation sticky. It keeps central banks cautious. It keeps rate cut optimism compressed. And compressed optimism tends to leak out first from speculative corners of markets before anyone wants to admit there was ever anything fragile underneath. You can already feel how fragile consensus really was. One day traders talk about easing tensions. The next day they revisit support levels. Then they look at Fed uncertainty. Then they glance at equities, losing trend structure. Then they realize no single story controls all these variables anymore. That realization arrives late, but never too late for price. Price always knows before commentary catches up. We've seen this pattern repeatedly. When macro stress intensifies, Bitcoin often behaves less like an exotic gamble and more like liquid monetary protest, a refusal, quiet but unmistakable, to place full faith in systems dependent upon endless coordination between governments, central banks, energy, routes, and public confidence. Now ask yourself another thing. If oil continues drifting lower, while geopolitical tension remains unresolved, does that mean calm return? Or does it simply mean traders decided danger could wait until tomorrow? Markets love postponement because postponement feels profitable right up until settlement arrives. And settlement always arrives. Sometimes as volatility, sometimes as policy shifts, sometimes as renewed demand for hard assets that do not need speeches explaining why scarcity still matters. That's where Bitcoin stands apart from almost everything else discussed in these sessions. Not because it never falls. It does fall, and often sharply, but because each downturn tends to clarify, rather than destroy its thesis. Every wave forces comparison. Every comparison forces ranking. Every ranking exposes what people truly believe about money under pressure. If you want honesty from financial systems, watch what survives allocation when fear stops being theoretical. Watch where liquidity goes when headlines stop flattering sentiment. Why? Watch which assets attract bids because they reflect certainty instead of promising performance art dressed up as innovation. This latest move gave us exactly that kind of glimpse. Bitcoin bounced first among major cryptos, while others trailed. Oil softened while war risk remained alive. Stocks weakened below an important trend, meat. Archer, caution, tightened expectations, and capital had another chance to reveal who it trusts when conditions stop being comfortable. No applause needed, no grand declaration required, just structure revealing structure. Maybe that's why these moments feel so charged, even when nothing dramatic seems finished yet. The visible event, oil down, Bitcoin up, is only surface tension. Beneath it lies something older. Humans pricing danger against desire. Humans repricing future consumption against present fear. Humans discovering that money choices are never separate from political reality. Humans learning, slowly, reluctantly, that sounder stores of value tend to gain relevance precisely when institutions become loudest about stability. Strange world, isn't it? The louder authority speaks about control, the more quietly capital searches for escape routes through assets built on rules rather than promises, through scarcity rather than expansion, through finality rather than flexibility, purchased with dilution through code rather than committee, and then comes admiration, reluctant maybe, but real, an open network surviving years of volatility without needing rescue. Elsewhere, a form of money whose scarcity cannot be negotiated away by emergency language. That deserves attention whether one likes it or not, because e-civilization eventually respects whatever refuses inflationary theater long enough to remain useful when usefulness matters most. Still, we should stay sober here. One bounce does not erase conflict. One pullback in oil does not remove supply risk. One rally in Bitcoin does not guarantee smooth continuation. One weakness in equities does not prove collapse. These are signals inside motion, not conclusions outside time, but signals matter because humans act on them before certainty exists, and action shapes future price. So we observe carefully if crude holds near support instead of breaking down decisive. Inflation anxiety stays alive. If stocks remain below key long-term trend levels, risk appetite stays defensive. If rate cut hopes keep shrinking, liquidity stays choosy. And if Bitcoin continues outperforming relative majors during these swings, then we are watching preference harden around CR. Edibility rather than novelty, which would be entirely rational after all. Money seeks shelter where voluntary confidence concentrates, not where marketing shouts loudest, not where speed looks glamorous, not where utility depends on endless external approval, where shelter holds, capital follows, where shelter holds. Ere shelter fails, capital remembers. So yes, Bitcoin at $70, 800 matters. But what matters more is why it moved there while other names lagged. In that gap between Bitcoin strength and altcoin hesitation, we see something enduring. Investors may chase many things, yet under strain. Aren't toward assets least dependent upon institutional choreography. There's no mystery there, only human action, only preference revealed by stress on the leaf. Why truth, arriving disguised as price. Let the noise around oil settle where it may. Let officials issue statements. Let analysts draw lines on charts. Let commentators call each bounce proof or each dip disaster. We will keep watching what actually changes behavior, because behavior leaves tracks, and tracks tell stories louder than opinions ever could. Maybe next time you see Bitcoin lift while everything else hesitates, you'll notice what really happened, and not hope inventing itself, but confidence choosing its refuge before everyone else admits fear was present all along. The question isn't their markets will remain volatile. They will. The question is whether you'll keep mistaking temporary relief for lasting order, or recognize how quick order disappears when money loses its anchor.